Hi, everybody. Welcome to another session of Come Learn with me. My name is Batel. Today, we'll be looking at the article, which asset class is more attractive right now, stocks or bonds? Let's get started. A reader asks, wow, unusual year with both stocks and bonds down at the same time. I'm in my early 60s and still 5 to 7 years from retirement. The current market environment has me wondering what is the better position to be in when interest rates inevitably peak and begin to fall, and the inevitable rebound in stocks, down 18% and still sitting in bonds, or down 25% and sitting in stocks? What is your opinion? I like this line of thinking. Lots of investors in today's market environment are viewing the losses in stocks and bonds strictly through the lens of risk. Losing money stings, but I prefer to look at bear markets as an opportunity. And with both stocks and bonds down big this year, there's no shortage of opportunity right now. Let's start with bonds. Fixed income yields are higher than they've been in years. Here's a graph to describe that. It's bond segment and average yield to maturity. But depending on your tolerance for risk and volatility in bonds, yields right now range from 4 to 9%. If we're doing a relative value comparison between stocks and bonds at current levels, today's higher yield is fixed income might be even more important than inflation or the Fed, if that's possible, because investors finally have an alternative to stocks for the first time in well over a decade. Yes, real yields after inflation are still negative, but for the first time in a long time, nominal yields provide competition for the stock markets in a way they haven't in a very long time. And locking in yields at these levels will look even better when inflation falls. Over the long term, higher yields on bonds lead to higher returns. In short to interim term, the things that matter most in terms of volatility for fixed income is the direction of interest rates. To keep things simple, there are basically three scenarios for bonds to consider. 1. Interest rates falls. 2. Interest rates stay where they are. 3. Interest rates rise. Inflation is the wild card here for real returns, but let's look at each of these scenarios to gauge how bonds would react. If rates fall, bond prices will rise, and the more duration and the longer your maturity, the better your bond will perform. When you combine higher starting yields with falling interest rates, that's a good short-term outcome for bonds. This would be caused by inflation falling, the Fed lowering interest rates, or a possible recession where investors rush into the safety of bonds. I actually think this is the worst case scenario for fixed income investors because it would mean better returns over the short term but lower yields for future returns over the long term. What if rates continues to rise? Prices would certainly fall in the short run, but today you have much higher starting yields than when the rate hike cycle began. There's a much bigger margin of safety starting from rates at 4 to 6% than rates at a 0 to 2%. If you own short-term bonds, they would not lose as much money in this scenario as long-term bonds. Remember, longer duration bonds perform relatively better in rate fall, but shorter duration does better, relatively speaking, when rates rise. If inflation stays high and interest rates continue to go up, there will be more short-term pain for bond prices, but that also means higher yields for future returns after you eat those losses. Finally, what if rates just kind of stay put for a while and stay at a range of, say, 4 to 5%? This is the scenario where investors could expect the least amount of volatility and simply clip those coupons and earn some yields. Bonds typically aren't as volatile as they have been in these past 3 years or so. Bonds are supposed to be boring, so most investors would welcome an environment where yields just chill out for a while. With yields at much higher levels, the probability of good outcome in the bond market is as high as it has been in years. Now let's look at stocks. If interest rates do begin to roll over, you should assume that the stock market would do well, but there's no guarantee that will happen. The stock market is something that something of a rebel that likes to break the rules. If you look at the historical data, rising or falling interest rates don't have nearly as much of an impact on stock market performance as you would think. Here's a graph to describe that. Rising or falling inflation has had a far greater impact on stock market performance than rising or falling interest rates. However, if rates fall, one should assume inflation is falling as well in the current environment. Again, no promises here, but the combination of a decline in rates and inflation would seem to be a good thing for stocks. But what if inflation and interest rates are falling because we go into a recession? Is that a good thing or a bad thing for the stock market? Is a recession already priced in, or would things get even worse in that scenario? I honestly have no idea how long bad news in the economy would be considered good news for the stocks, because it might mean the Fed can back off. Recessions are usually not great for the stock market, but an economy contraction in 2023 would be the most telegraphed slowdown in history. As always, the short term in the stock market remains unclear. However, buying stocks when they are down, this match has tended to work out well for investors over the long run. Readers might be getting sick of this data, but it bears repeating in a bear market that buying when stocks have gotten hammered has been a profitable long-term strategy historically. Here is the data to describe that. The past is no guarantee of future performances and of all the usual disclaimers, but it makes sense to me that buying stocks when they are down 20 to 30% would be a winning strategy, as long as you have a long enough time horizon. If I had to bet my life on it, bonds are probably a higher probability bet in the short to interim term, while stocks will provide more bang for your buck in the long term. That's not exactly going out on a limb, but the good news is that you don't have to bet your life on these things. The beauty of diversification is that it relieves you from the stress of picking winners all of the time. Diversification doesn't always work in the short run, but it all but guarantees you'll own winners over the long run. This has been a painful period for investors with stocks and bonds heavy portfolios. I'm not trying to sugarcoat it. But the current setup of much higher bond yields and lower valuations for stocks leads me to believe that eventually both stocks and bonds will offer much better outcomes than investors have gotten this year. I just don't know when that will happen or which asset class will be the winner in the coming months or years. We discussed this question on today's portfolio rescue. Here is their YouTube channel if you would like to go and see it. And then I think that that's the end of our article. If you like this, please like and subscribe. Thank you so much for joining us. Please click the links in our description below to see how our business can help yours. We hope you have a good day.